gold is over $3,600 for the first time ever. The previous all-time record looks like it was 3,580 a couple of days ago, but you know, it was. If we look here, it was closing at what was it? About 3,504. Let's look at the silver price. Goodness me, that's over $41 again. It did have a few forays over $41 in the last few days, but it's here on the 3rd and then again on the 5th, but it didn't quite hold that $41. It's now over $41 again. Let's see if it can hold there. So I was going to tell you that silver's over $40 an ounce, but it's over $41 now.
Gold has broken above $3,600 and silver is holding over $41, marking fresh strength in precious metals. Clive Thompson, a market commentator known for tracking precious metals and global macro trends, highlighted that gold has surged to unprecedented levels, crossing the $3,600 mark for the first time in history. Only a few days earlier, it had already set a record around $3,550, but it has now climbed further to $3,611, about $70 higher than Friday's close. Silver has also shown renewed strength, rising above $41 after briefly testing and retreating from that level in recent sessions. Both metals appear to be attracting significant inflows, reinforcing their role as safe haven assets during times of financial uncertainty. Turning to Europe, Thompson noted that France is under growing financial pressure, as reflected in its bond markets. The country's 30-year bond yield is currently around 4.38%, close to recent highs, and well above Germany's equivalent at 3.29%. The gap persists even on shorter maturities, with France's 10-year yield at 3.44% compared with Germany's 2.67%. Despite both countries operating under the same currency, the euro, these divergences highlight investor unease about France's debt sustainability and, more broadly, concerns about the long-term stability of the eurozone. Meanwhile, China is facing its own set of challenges, particularly with slowing exports to the United States. To counter these headwinds, the People's Bank of China has injected liquidity into the financial system, aiming to stabilize government bonds, support equities, and provide relief to the property market. These interventions have helped lift sentiment in Asian markets, with indices such as the Nikkei and Hang Seng posting notable gains. Before we dive deeper into the discussion on gold, silver, and the unfolding changes in the global monetary system, don't forget to like this video, subscribe to the channel, and hit the bell icon so you stay updated with every new insight.
Let's go to gold. Here we are. Gold, dollars. Oh my goodness, it was an all-time record at 3,550 a couple of days ago, Friday rather. It's up $25, it says today, a bit more than yesterday's open. So yeah, $3,611. Gold is over $3,600 for the first time ever. The previous all-time record looks like it was 3,580 a couple of days ago, but you know, it was. If we look here, it was closing at what was it? About 3,540. So it looks like it's up about $70 since most of Friday. And while we're on it, let's look at the silver price. Goodness me, that's over $41 again. It did have a few forays over $41 in the last few days, but it's here on the 3rd and then again on the 5th, but it didn't quite hold that $41. It's now over $41 again. Let's see if it can hold there. So I was going to tell you that silver's over $40 an ounce, but it's over $41 now. Now, while we're on gold and silver, which both look like they got money going into them, I'd just like to remind you that I have 2 affiliate links down below. One is for gold bullion partners in the UK and for European buyers as well, and the other one is for ITM trading in the USA. So if you want to buy a lot of gold, these are great people to buy from, and they've got the telephone number of each company is below this video. You can see it, and there's also a link to their website if you want to look there. So you can call them up if you want to buy a lot of gold. Now let's move on to Europe and what's going on in France, because we have a bit of a problem in France this morning. So France is in a political crisis over its tough budget plan. It's a tough budget plan because it freezes the government spending, increases taxes on pensioners, reduces the number of bank holidays and things like that. And it needs a tough budget plan because its debt is very high. It's 110% of GDP. It's one of the highest debt to GDP ratios in Europe. And the reason it's got such a high debt to GDP ratio is, like so many other countries, like the UK, like America, like Japan, each year France spends more money than it collects in taxes. And so last year the budget deficit was about 5.5% of GDP, which is well above the maximum target proposed by the EU, which was you shouldn't have a budget deficit, if you have one at all, of more than 3% of GDP. So they're way out of line there, and they should do something about it. And of course the ECB wants them to do something as well. That's kind of what the ECB is there for, to encourage the governments of each country to be strong and not run deficits which are too high. But the France's deficit is too high, and that's why they got this strong budget. But this is causing a political crisis. So I mean, one of the problems they're going to try and solve with this budget is the ballooning interest on debt. So just to illustrate this, how bad the problem is, it's spending over $50 billion a year on interest. France 30-year bonds. So 30-year bonds, it's at 4.38%. It's not far off the maximum perhaps a week or two ago, but it is a very high rate. But if we compare that with the German 30-year bond, so France at 4.3738, Germany at 1%, more than 1% lower, at 3.29%. And if we look at the 10-year German, it's at 2.67%, and the 10-year France at 3.44. So France's bonds are yielding, even though the currency is the same, it's euros, Germany uses euros, France uses euros, the yield on the bonds is significantly different. And what's that reflecting? It's reflecting the fact that bond investors, they're being bond vigilantes, but they're telling us that they have doubts about whether the euro will still exist some years from now, certainly 30 years from now, because of the huge difference in interest rates between Germany and France. And they're wondering, will France ever repay, or will they ever be able to repay their debts? That's kind of where the difference in yield, what the difference in yields is showing us. So what else is going on? Well, China has said its exports have slowed, hardly surprising because of the exports going to the United States is going down. So the People's Bank of China, the PBOC, has injected liquidity in the market to try and support government bonds, support equities, shore up housing, that sort of thing. This morning in Europe, the European stock markets are not all, but mostly starting to rise. So we go to look at the indices here. Just go here. The stocks. Yeah, here we are. So we look at the CAC 40. Despite the political turmoil in France, it's up a little bit this morning, up 0.25%. Germany up more than 0.5%. And if we run the Euro stocks down 0.25%, the FTSE 100 down ever so slightly at 9218. Barely changed. We see that Asia was up. Hang Seng Index was up nearly 1%, and that's obviously thanks to the liquidity coming to the market from the People's Bank of China. And the Nikkei Index is up quite a nice percentage. It looks like 1.93%, not bad. And you can see that rising strongly in the. Let's put that to a 1 month chart. No, that doesn't work. Let's go like that and auto fit. So there you go. You can see the Nikkei index has risen quite sharply in the last few days. And looking at the China index, that's not far off the recent highs. And the Nikkei.
Clive Thompson, reviewing a 5-day chart, pointed out the difference between post-market and pre-market trading, noting that Robinhood had closed at $101.25 but was already up nearly 7% in pre-market at $108.83 following the announcement of its addition to the S&P 500. He also revealed that a major investor is preparing to pour billions into a select group of gold mining companies, reflecting growing confidence in the sector at a time when gold prices continue to to climb and precious metals attract strong inflows. Shifting focus to broader market dynamics, Thompson explained that while lower rates ease short-term borrowing, they could steepen the yield curve if traders sell long-dated bonds, pushing yields higher. This dynamic would increase the U.S. government's long-term borrowing costs, worsening its fiscal position as interest payments consume more tax revenue. He cautioned that if a recession hits, falling tax revenues combined with inflation-driven pressure on long-term yields could intensify the crisis, amplifying risks across both debt and equity markets. Let's get back to the interview.
Just look at the Dow Jones and the S&P last night. Dow slightly down last night, but still pretty close to the all-time high. Now, what else have we got going on today? Yes. On Wall Street, we saw Broadcom rise sharply. I haven't got that one on my screen. I can't show that one immediately. And Robinhood, here we are. Robinhood rose sharply. I'll put that into just the 5-day mode so you can see the white area. The light grey area is post-market, and the white area is pre-market this morning. So you can see Robinhood, which closed at 101.25, is now trading in the pre-market at 108.83. So it's up about 7% on the news that Robinhood is going to join the S&P 500. A major investor is about to invest billions into the shares of a very small group of quoted gold mining companies. And I do mean billions, not millions. Now, this information is potentially available to you if you're an internet sleuth, but it's hard to find. And it's just not been reported by any other YouTuber or by any news outlet as far as I can tell. So I'll probably, when I bring this video out, I'm working on it as fast as I possibly can. I'll probably be the first to tell you all about it. You probably won't find it with a Google search, but even if you do, it will be very difficult for you to discover which gold mining shares are going to be bought. But I've spent all day Sunday digging deeper and deeper to find that out. Now, these purchases will probably not be made this week. They'll probably be made next week by this investor. Now, the reason the stock market hasn't crashed on this news of terrible labour results and going into recession and so forth is that the stock market is forward-looking. It now sees a virtual 100% probability that interest rates will be lowered on September the 17th. Lowered because the employment numbers were so bad. So, if interest rates are lowered, it will lead to higher inflationary expectations and lead possibly to a steepening of the yield curve. Now, what's a steepening of the yield curve? It means that the short-term rates set by the Federal Reserve might be going down, they're lower, and they're lower than the longer-term rates, which are not set by the Federal Reserve, they're set by the markets, by you and I buying and selling bonds. So even though we might get, and we almost certainly will get on September the 17th, an announcement that the federal funds rate is coming down by probably 0.25%, traders might sell the longer dated bonds, lowering their prices and thus increasing the yield. That would be a steepening of the yield curve. So let's go on. I'm getting to the point why this is good for the stock market, because again, higher yields would seem to be bad for the stock market at first sight. But in this particular case, in this situation, the higher yields will mean that it becomes more costly for the US government to borrow money, at least if they're borrowing longer duration bonds, issuing 10-year or 30-year bonds. Now, because the US government's already in a debt crisis, it's deep dodo with far too much debt it can't handle, high interest rates are a problem, because the interest rates and the interest payments on the government debt, the amount they borrowed previously, is already consuming a huge percentage of what the government collects in taxes. And every year, for the last few years, it's been consuming more and more of that government tax take. And according to the Congressional Budget Office, the CBO in America, that's the government body, these figures are only going to get worse. And that's, according to their numbers, assuming no rise in borrowing costs. And I'm telling you, it's possible that borrowing costs will actually rise here. So, based on their own numbers, the debt and interest payments are set to spiral out of control at some point. We can't say when it spirals out of control. It spirals out of control when suddenly confidence is lost and everyone says, I'm not buying any more government bonds. But it's not a question of if, it's a question of when. And how long can we keep kicking the can down the road? And I think that can happen for a long time. If we go into a recession, the tax take will fall. And potentially the borrowing cost on longer dated bonds will rise. So, on inflationary expectations. So this will only accelerate the fateful day when everything goes wrong. Now, to stop that happening, it's likely that the Federal Reserve will step in to buy longer dated bonds. They'll be buying the bonds that nobody else wants. They'll be buying the bonds where the government wants to borrow money, but nobody wants to lend the government money. So the Federal Reserve steps in as lender of the last resort to the government, effectively, in this case, not to the banks. So as they do this, they're buying the bonds, supporting the prices or even raising the prices, and as the price is supported or raised, it stops the yields from rising, and the yields can go down if they buy them and push the price up. So this is called yield curve control, YCC.
Markets are being pulled between short-term relief from rate cuts and the growing threat of soaring debt, fragile bond markets, and rising inflationary pressures. Central bank liquidity injections and the prospect of yield curve control highlight just how strained the system has become, where confidence could unravel suddenly. In this environment, gold and silver remain key safe havens, not only serving as protection against monetary instability but also acting as signals of deeper systemic stress, reinforcing the need for preparation and resilience that extends beyond financial measures alone. What impact could mount debt pressures and central bank bond buying have on the future price of gold and silver? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.